Hey guys, welcome back to the channel. Today I'll be going over a script that intends to find reversals in ETFs based on gaps. And what I'm trying to find in the script is the average time in days that it takes for the ETF to close the gap based on gap percentages. So let's go over the script. As an example, I'll be testing the Dow Jones ETF. And for this script, you'll need to get this function, and I'll post a link down in the description area. And what this function will do is grab the constituents of any ETF. So let's go ahead and assign our ETF. So we'll go ahead and run that line. We'll get the constituents. And for the constituents, we're only going to grab the tickers, but the table looks something like this, where you have the symbol, the company name, and the percentage weight. So for the Dow Jones, we're going to test these 30 tickers. We're going to go ahead and assign that. Now for each of these tickers, I'm going to pass them into a list. We're going to go ahead and grab the data and calculate gaps on a daily basis. Now if we open this up, we can see we're going to grab our data from Yahoo Finance starting at the end of 2017, and that's because there might have been some changes in the constituents. So I'm only going to test these last couple of years. After we get our data, we're going to add a column with the previous close, and that'll facilitate us calculating the gap, which is just the opening price divided by the previous close, and we're going to return that as a percentage. We're going to rename that column so that we know what ticker this data is for, and return the gap percentage on a daily basis. Now I'm going to run that block. Let's take a look at our data. Now for this table, we have all 30 constituents, and these numbers represent the opening gap as a percentage. Now what we're going to do is we're going to use this table, and for each day, we're going to calculate how many stocks gapped up and gapped down, and also return the average gap based on the user's input. Say we only want to focus on gaps greater than 1% or less than 1%. We will be able to focus on extracting that data from this table. So let's go ahead and close this out. This next function will help us reduce or subset our data based on the threshold. So if we open this up, we can see that we're passing in our data. The user inputs the threshold. So say the threshold was 2%, we're going to get the number of stocks that gapped up greater than 2%, and also the ones that gapped down less than negative 2%. And this is done on a daily basis. Since we're focusing on rows, we're also going to return the average gap as a percentage, the total number of stocks, which is just the number of columns in our data. I'm going to add some other stats, such as up minus down, which we take the number of stocks that gapped up minus the stocks that gapped down divided by the total. And in line 37, we just combine our data and reclass this as an XTS object. I'm also going to make the count as a percentage. So here I'm just dividing the up count and the down count by the total number of stocks. And finally, just return our XTS object. So let's go ahead and run this function. We're going to test this out by adding the threshold of 1%. So let's run that and take a look at the table. So for each day, we see the number of stocks that gapped up, the number of stocks that gapped down, the total number of stocks in our ETF, the average gap, the up minus down, and the total number of stocks gapping up and down as a percentage. Now that we have this table, let's add our ETF data so that we can test how many days it takes for the ETF to close the gap. So let's go back to our script. I'm going to grab our ETF data from Yahoo Finance, merge it with our table, and I'm going to add the previous close, which will make it easier in the next function to calculate what price the ETF has to reach to close the gap. So let's go ahead and add that. Now in this next function is when we actually calculate the average length of days based on the gap percentage that you want to focus on. So based on the gap percentage that the user enters, we will subset our ETF data. Once we have that subset, we're going to extract the dates in temp, and we're going to pass that as a list into this function. And for each of those days, we're going to extract the closing price, the actual average gap as a percentage based on the constituents. We're going to add a direction. So if it's a gap down, I want to be long. If it's a gap up, I want to short. So we're going to add that as a column into price. The next block, we actually figure out when the gap closed. So if the signal is 1, we're going to be focusing on the highs. If it's a negative 1, then we're going to be focusing on lows since we're short. So again, looking for that intraday gap close. We're going to start 1 day forward so that we don't accidentally return the same bar and count that as a gap close. So once we get a signal, we're going to focus on days after we generated the signal. And for advanced, that's for our quant lips. So let me go ahead and add that package as well. So by using advanced, we're just going to get 1 day after we generated our signal, again, so that we don't count the same bar. we're going to add the gap to fill, and this will be the price that the ETF needs to rise to or fall to in order for us to close the gap. Next, we test all ETF prices after we generated our signal that are higher than our gap that we need to close. And again, we're using the high if it's a positive signal, and we're using the low if it's a short signal. So this will return the location of all the prices that are greater than the gap that we need to fill. But we're only going to focus on extracting the first instance of where that happened. And it may be that the gap hasn't closed. And if that's the case, then the length of ILOC will be 0. So if ILOC is not equal to 0, we're going to return the number of days that it took for the ETF to close the gap. We're also going to get its price and the date. We're going to return that as a data frame by merging our signal date and our core data. And finally, we're going to add a column for the fill date. Now, if ILOC is equal to 0, that means that the ETF gap has not closed. So we're going to return NAs for the days to close, the fill price for the date and the fill date. Otherwise, if it's a short signal, we're going to do the exact same, except we're only focusing on the lows. And again, if the gap has now closed, we're going to return NAs. And after we made our calculations, we're going to return our data frame. So let's go ahead and minimize this function. We'll go ahead and run it. And we're going to test gaps greater than 1% or less than negative 1%. And we're going to return that in all. So let's open up that table. We have 134 different entries. Here I'm going to sort by signal. So as a reminder, when signal is -1, it means that we are short since the average gap is greater than 1%, the date and the price on where that event occurred, the gap we need to fill. So for this instance, the ETF rose to 241 from 235. It took 4 days to close the gap, in which the lowest price intraday was 233. And finally, the date of the intraday event. So it looks like for this ETF, we have a couple of open gaps, mostly on the short side. And if we scroll down to the long side, it looks like the majority of these are closed. We do have a couple that are open, but from here you can test the average length or make different calculations based on this table. But this concludes the video, guys. I'll leave a link down in the description area to the Patreon where you can find this script. Please subscribe to the channel if you haven't done so already. Thank you so much for watching, and I'll see you guys in the next video.